afternoon, everybody. Thanks, PMS Bazaar, for giving me the opportunity to speak today. Just to introduce Karma Capital, we started in 2005. Our track record is now 16 years. We've been around for a long time. From a AUM perspective, we manage close to about $500 million. A lot of it is offshore institutional money. Norges Bank, which is Norway's sovereign wealth fund, is our largest client. We've been, in terms of philosophy, we are growth at reasonable price in terms of, if you want to classify us in terms of where we fall, in terms of our style. And we only do long-only India equities. So that's really a brief background on the firm. Some of my colleagues are here with me and, to maybe give you more details about it if you're interested. What's our investment philosophy? And I think that's just a very interesting slide from our perspective. We run concentrated portfolios, 20-25 names, market cap agnostic, index agnostic. We are, as I said, growth at reasonable price kind of investors. We are early cycle, and I'll talk about cycles in a bit, which is the more interesting part of the presentation, which I mentioned earlier. And we run an all-cap strategy. Most important thing from our perspective is the fact that we have a kick the tires, bottom-up approach. And that allows us to develop an independent view of the world. And I'll tell you, I'll come to that in terms of why it is so important. Patience and discipline, of course, when we manage money is from a long-only perspective is key to our success. Just a quick bit on the process. Again, I'm not going to bore you too much with it. This is how we look at our universe. This is very important. The process is the most important thing from our perspective. I think 16, 17 years of existence, we've tried to imbibe this as a DNA in the organization. 8 people research team, and all of us kind of, the most important and sacrosanct thing is how we work through our research ideas, how we find our investment ideas. And this is a snapshot of how we look at it in terms of, 2,000 odd companies listed, 500 if you kind of put liquidity and basic ESG criteria to it, boils down to about 330, 340 names that we track very closely as a team. So eventually boiling down to about 20, 25 names, high conviction names in the portfolio. This is how our universe looks like. It's an all-cap universe, companies spread across sectors and market cap. If you look at our universe of 330 odd names, you will have small, mid, and large cap across the market cap. This is the most important slide, slightly busy, but just very important from our perspective, how we look at it, how the team interacts, how we kind of distill down in terms of our universe to our eventual stocks in the portfolio, what work goes behind it. So just to give you a flavor of it, we own about 20-25 names in our flagship strategy. Our churn is low. We own companies for 5 years once we buy them. And we add maybe 3 or 4 names a year, maybe remove 3 or 4 names a year. And this is the back-end work which goes into it. What we like, how we look at companies, what is the focus of the investment team, which meets almost alternate days. And the key criteria that we look in terms of balance sheets, in terms of return on efficiencies. But I think where we differ slightly from a lot of people is we look at rate of change. To us, the rate of change is a very, very important criteria. We are not too fixated on a high number on the capital efficiency. We are looking to see where companies can at times in cycles start from a slightly lower capital efficiency, but we want them to be achieving a significantly better capital efficiency over the next 3 to 4 years. So I think rate of change for us across not just capital efficiency, but growth across profitability is far more important than an absolute number. Therefore, I will come to that the future is more important to us than the past. So eventually this kind of boils down to the high conviction ideas that I spoke about earlier in terms of the portfolio. This is how we look at our portfolios. We size our positions. We start small. We build 20-25 names. Over time, we build the position. So we would start every position at about 1.5%, then build it up. Today, our portfolios are quite top heavy in the sense top 10 names would generally form about 60-65% of the portfolio. And also the fact that we are not really timing the market. Largely our strategy remains fully invested. And that's really some of the mandates also that we have from our offshore investors. So enough of the boring stuff. Let's get to the more interesting stuff. I introduced Karma and now to what we do. So from our perspective, everything goes through cycle. So you have heard a lot about the India story in the past. What we want to give you is a different flavor to the India story. What we think is our sense of what is happening and what will be the future, and where we are today in terms of the cycle. So change is constant and everything goes through cycle. Like human beings, businesses, industries, economies, everything goes through cycle. It's just a question of where you are in the cycle and how long is the cycle. It's a very simplistic chart that we have put up. This is what has at least helped us over the last 25, 30 years that we have been investing. So this is a very interesting chart. It's very simplistic. It's very interesting. If you look at, there are two lines there. The green line is the business and the blue line is the price. Always the businesses turn around and start doing well. The narrative at that point of time, which is the bottom of the cycle, still is negative. So the price continues to kind of be unfavorable. And then the narrative slowly starts to change as businesses start to gain momentum in their cycle. And then as the narrative changes, the prices start to kind of catch up. So to us, these two graphs have kind of worked very well. It works time and time again. You can go back and test it over various businesses, various companies and how they have behaved. Typically, the businesses bottom out first and then the prices bottom out and start to do well because the narrative always lags the underlying business. As people quote, a lot of people, I heard the song and I really loved the wordings of it, of Taylor Swift saying that it is very difficult to bet on an anti-hero all the time. So when we buy these companies sometimes, we realize that when you look at their past doesn't look that exciting. But exactly the reason why we are buying, because we think there is a change happening, there is a significant catalyst to the change, and that change when it unfolds can have significantly better or superior returns. So to us, the future matters far more than the past. But that also means that when we buy into the name, sometimes those are the anti-hero names. People don't really relate to them. People always tell us, oh, look, this company has not gone anywhere in the last 3-4 years. And that's where the challenge for us when we kind of explain this to investors. So people ask us how you are different. I tell them when they ask me this question that are you willing to accept when we say how we are different? Because generally the mind has a cognitive dissonance. When you say that you are different, the other guy already has made up the mind because he has a view. And that kind of creates a challenge for people like us. That's why I wrote the quote from Taylor Swift. So I'm sure you heard enough about the India story and India's journey from here to wherever it will be in the next 5, 10, 20 years. Our sense is that if you look at the last 10 years broadly, we went from $1,000 to $2,000 per capita, 2,300, 2,400. It depends on when the dollar is. As we go from 2,500, 2,400 to maybe $5,000 over the next 7, 8 years, the journey will be very different from the past. The businesses that are going to do well might be very different from the ones which have done well in the past. And to us as investors, that I think is the most critical thing. We need to spot companies, businesses which will do well in the future, not businesses which have done well in the past and kind of extrapolate them saying that this is what is going to continue to happen. No doubt some of the companies will continue to do very well from the past, but I think there is going to be a lot of change. And we've kind of highlighted some of the sectors where we see the change. So what is the change which is happening in the businesses? A lot of businesses in India are going from fragmentation to consolidations, where industries are getting consolidated very rapidly, and where we see, therefore, a huge catalyst in terms of these industries because the consolidation is so rapid. What it does, it gives, as companies consolidate, it gives them pricing power, it gives them better ability to negotiate, it just makes them far more powerful as a business entity. On the other hand, a lot of industries will go through fragmentation. And we've kind of listed out some of the industries where we see consolidation. We see consolidation in healthcare and pharma. It's a structural story. The consolidation in the domestic markets will continue for a long time. It's not going to be quick. It's going to be maybe a multi-year, at least a multi-year story, if not longer. Telecom, we have already seen consolidation. Media, we are seeing consolidation as we speak, and I maybe have more interesting stuff as I going to go along. Airlines, again, another industry which has seen significant consolidation. Similarly, on the other side, we are seeing fragmentation. Maybe people call it disruption, whatever you want to call it, whatever name you want to give it. We are seeing that in two-wheelers. Fantastic example, change in the powertrains, EVs kind of disrupting, the top 3 companies in EVs being very different from the earlier leaders. Paints, we are seeing disruption. We are seeing fragmentation happening. We are seeing fragmentation happen in our businesses like asset management and general insurance. And then we are seeing fragmentation happen in FMCG. I'll quickly take you through some of these industries, examples, and what we think is happening in each of these industries. So if you look at telecom, the biggest disruption happened when Jio entered in 2016. There were 8 operators at that time, highly fragmented telecom business. Today we have 2.5 operators in telecom. The top 2 guys control almost 80% revenue share. And what it has done is it has created a huge moat to the industry. For anyone now, any even global player to enter Indian telecom market, especially the mobile market, is practically impossible. So my sense is this is where you will see pricing power. It's not going to be tomorrow, but it is going to be more structural, more longer term. And you're going to see significant value accretion to the existing large players. Similarly, healthcare, we've kind of, we have a little bit of bias here because it is one of our largest holdings. We see domestic healthcare continuing to consolidate. The top 20 players in pharma in India control 40% of the market. It's highly fragmented. There are 2,500 pharma companies. We think that the domestic pharma market will continue to consolidate, as I said, at least for the next few years, if not longer. Slowly, the top 10, 20 players will continue to become bigger and bigger. And it's a fantastic market to be in. It generates high ROIs, significant free cash flows. The only problem we saw in pharma was the capital allocation was not great because a lot of these companies, when they grew in India, they used that capital to buy overseas businesses in US and other parts of the world. And that kind of had a negative connotations because they didn't make so much money on those investments. My sense is that the capital allocation in pharma has now become much better. The top companies have learned their lessons, and that you can see on their balance sheets. So their balance sheets for top 5, 6 pharma companies are now pristine. They're all generating very strong cash flows. And we see that this growth momentum will continue as the consolidation continues in the pharma business. For the other 2 sectors where we see significant consolidation happening, if you've seen, media is very interesting. As we speak, the consolidation is happening. I'm sure you might have heard about Zee and Sony merger. That Disney, of course, is the largest player in the industry. And the next one will be the Reliance as a group. And they are merging with Bodhitree and Lupa, which is Rupert Murdoch's company. And they are going to, the top 3 companies here will control again 75-80% of the market once this consolidation is done. We are in maybe the last leg of the consolidation. Both of them are kind of waiting for NCLT approvals. We think this is going to be a very, very exciting area. As the journey from 2,200 to 5,000 goes, the spend patterns will be very different. You will see significantly more money being spent on healthcare, on entertainment. These are the discretionary areas, and we can see that already happening. The screen fragmentation, the digital initiatives like OTT are all going to drive this incremental consumer spend as the country grows from 2,200 or 2,400, wherever we are, to $5,000 per capita. And the last one here is the airlines. I'm sure all of you have seen the the Airbus and the Boeing orders by Air India. Today, both these, that's Indigo and Air India, Tata's put together, own almost 80% of the market in airlines. I'm sure you all know that there was a huge fragmentation in the airlines business 10 years back when there were multiple airlines started, including Kingfisher's. Jet was still alive at that point of time. We think that a huge moat has been created in the airlines business. So if you think about the airlines business, between Indigo and Tata's, they have now almost 11 to 1200 aircrafts on order. The problem with airlines industry is there is not enough aircrafts available. So even if I want to, as a new airline, start in India, there is not enough aircrafts available and there are no more landing slots available on the airports. So I think it's a huge entry barrier. So again, the same thing. It's a huge consolidation which has happened. And our sense is this is a high entry barrier business. This is not going to change in a hurry. And our sense is incumbents are going to enjoy a lot of pricing power. So be ready to pay for higher air tickets if you are in India. On the other hand, what we think is happening in some of the other industries. So if you look at some of the other industries, a classical example is paints. Paints is going through significant fragmentation. It might not be today, but you have seen entry of large, well-funded players into the paints business. These players are not going to go away in a hurry. These players will vie for a reasonable market share, which is going to put pressure on not just the margins, but also volume growth. So typically when fragmentation happens, it leads to two things. Either you sacrifice volume and fight on price, which is what in telecom people did, or you keep the price but sacrifice the market share. So our sense is this is what is the challenge which is going to happen in a lot of industries where you are seeing fragmentation. So of course paints, as I said, is one of the industries. The other industries, of course, two-wheelers. As you could imagine, the two-wheeler business is going through the biggest disruption it has seen in at least a couple of lifetimes. The EV players are completely new. The top three players in EV are very different from the top three players in the industry today. And we don't know where the industry is going. So we don't even know how the future leadership will look like. There's going to be a lot of bloodshed before we see a final 2, 3, 4 winners emerge. The way to play a two-wheeler is to go horizontal rather than vertical. And that is what we are also doing, because we think that, as they say, in the gold digging mania, you are better off supplying the tools rather than digging for gold. The other industries which are going through fragmentation, FMCG, again, very large entrants, deep-pocketed people approaching FMCG from multiple directions. You have seen Reliance enter into FMCG through their private labels and their other labels. You've seen Adani enter, you've seen Patanjali enter, and the complexion of the industry itself is changing because, I was at a tier 3 city in India in a Reliance Smart, and a lot of the brands that you see on the shelf, you would not even have heard of. These are, some of them are organic brands, some of them are regional brands. So our sense is that in the last 10 years, you saw a lot of consolidation, and now you're starting to see fragmentation across some parts of FMCG. We still don't know how the market is going to evolve, but again, deep-pocketed players entering this, it's not going to end in a hurry. Same thing for the asset management business. So I hope somebody doesn't throw some stuff at me when I say that. Asset management business is also going through fragmentation. You see new entrants, you see a different set of people entering asset management business. You see regulatory risk with the asset management business. And the same thing, and you're seeing, of course, the digital disruption happening. And of course, people like us who are coming for the asset management business from the alternative side. So you're seeing multiple pressures, and of course, passive, which is becoming large in India, has of course become very large in other parts of the world. So you're seeing, and that's why you've seen a kind of a derating of some of these companies in the markets over the last few years. And our sense is until we see this play out, this is going to continue. The same thing we're seeing in general insurance. General insurance also is seeing new entrants, digital first companies entering the space, causing disruption for existing business models, causing disruption for incumbents in the industry. And of course, there also we see regulatory challenges emerging because of the talk of a combined license regime. So this is where I will wrap up my presentation. I just want to kind of spend a minute on this. This is where I thought about the cognitive dissonance we see. We always say numbers are important, but which numbers? Are the past numbers important, or are the future numbers important? I think as investors, for us, the past is important, but the future is more important. And therefore, from our perspective, this is very critical to what we do. We don't just focus on the past numbers, but we also focus on what we think is going to happen in the future. And that is really where we need to do a lot of work, because of course, it's not possible for anyone to predict the future, but at least you want to understand how the future might look, and therefore the numbers might look as we go along. And last, as we always say that when we talk of the path of least resistance happens. You know, people take the past and extrapolate into the future because they think that this is what is going to continue. We think that this might not necessarily mean a better performance, and therefore it's going to challenge a lot of the mindset. The rate of change, as at least we believe in India, is continuing to accelerate, and maybe the cycles are even becoming shorter than we would have thought initially. So to just kind of end my presentation, I would say that all great, I quote Howard Marks saying that all great investments start with a discomfort. And this is very critical from an investment mindset perspective. Thank you so much for your time.